This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss gold's recent rally, why investors are attracted to it, and the role it can play in portfolio diversification. Gold prices recently reached highs surging above $2,600 per ounce, driven by factors such as economic uncertainty, potential Fed rate cuts, geopolitical tensions in the Middle East, among other factors. While gold can serve as a store of value and hedge against inflation, its performance should be viewed in the context of other asset classes like stocks and bonds. It may be surprising to some, but stocks have outperformed gold over the past 2 decades across many different macroeconomic environments. That said, there are many reasons investors are drawn to gold, especially in times of uncertainty. When it comes down to it, investors should consider gold as part of a diversified portfolio strategy rather than a standalone investment, just like stocks should also not be viewed as a standalone investment by themselves. First, this chart shows the S&P 500 total returns and gold returns re-indexed to the cycle peak in 2007. This illustrates the role gold can play in balancing risk in times of uncertainty, but as you can see, stocks tend to outperform in other environments. One ideal scenario for gold is when the Fed is loosening policy and during financial and economic crises. Gold performed well immediately following the 2008 financial crisis and again during the pandemic in 2020. It's interesting to note that gold did not perform well during the recent inflationary period since the Fed raised rates rapidly, which favored assets such as cash and short-term bonds. This helps to illustrate one of Dynamic Wealth Group's core philosophies, one regular viewers are familiar with. It's the concept of preparation over prediction. You see, instead of always attempting to predict the future, true diversification should rely on preparing for the future regardless of what happens. We do that through our multidimensional asset allocation approach. Next, this chart tracks the performance of gold alongside the U.S. 10-year Treasury and German 10-year Bund yields. It shows that gold prices tend to move in the opposite direction of interest rates. Gold prices have risen in response to recent Fed rate cuts and have performed well compared to other defensive assets like short-term bonds. That said, interest rates have actually risen recently, with the 10-year Treasury yield jumping above 4%. While gold is near all-time highs, stocks and bonds can also benefit from falling rates, especially in a soft landing scenario. If rates are falling, but the economy is still strong, stocks could perform well even as gold and other assets rally. Finally, this chart shows the annual total returns for various asset classes, highlighting the importance of diversification across a variety of investment types to weather market volatility. Various asset classes, including international stocks and small caps, have contributed to broad market performance this year. This may be a surprise to many investors who worried about a recession or market collapse less than a year ago. With events coming up such as the presidential election and the next Fed rate decision, it's important to maintain broad exposure to different asset classes beyond just stocks or bonds. I hope you found these high-level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our eye-opening white paper titled Busting 7 Risk and Return Myths. You can click the link below or visit our website at dynamicwg.com or email us directly at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact-based financial decisions.